but we are trying to get them. In the 3 and 12 exclusion, it can be used by persons, which are defined as estates, trust, legal organizations. So LLCs, corporations can use these provisions, okay? So if you're doing one as an organization, this is what you're going to have to follow, because remember, the first one isn't available for them, all right? So even if you're just doing one and you're an organization, this is what you're going to have to follow, okay? Again, the builders can't use this. I was really surprised through this whole process that the builders weren't more upset about this. But, all right, the financing, this is where no balloons come in. So if you're doing 2 or 3, 2 or 3, no balloons, and there does have to be a good faith determination that the borrower can make the payments. However, the good news is that we also have to have a fixed rate or adjustable rate that we talked about in the first one, and it has to be tied to a reasonable index. The good news is that the good faith determination you have to do under this analysis is not the same that the lenders are doing. So that's great. Even better, they want you to do it, and they tell you exactly what they want you to be looking at. Income. If you're looking at employment income, these are the criteria. If you're looking at other income, here's some more criteria. Income earned assets, funds and accounts with financial institutions, all of these things. These are the things that they want you to look at, but you don't have to document it, according to them. Well, it says, but it's a good idea to have the documentation, so in case, you ever get in trouble for this, you can say, this is what I used, because otherwise you don't. So it doesn't require you to keep documentation that you've done this, but it's a good idea. Yeah. I don't know who's writing these regulations, but yes. So you do have to look at some things. You do have, and we do that anyway. Our purchase agreement says in there on the real estate contracts that the borrower is going to provide some information to the seller, and the seller is going to determine whether they think the borrower can actually make the payment. So, this isn't really much different than what we've been doing. I don't know if sellers typically keep the documentation. Again, they're not required to now, but I would say it's a good idea to hold on to it at this point. So obviously we're left with a lot of questions. One of the biggest questions is to what does this actually apply? Is it only the high cost or is it all of them? Other questions such as what happens if you make one and then you decide subsequently to make another, and you are a natural person, you haven't created an LLC, it's not registered in a estate or a trust or something like that. What do you do in that scenario? Are you actually precluded or prohibited from doing any more in that 12-month period because your first one didn't had a balloon payment in it and you didn't do an ability to pay analysis? Or do you have to go back? You obviously can't just go back and restructure that. You have another party to the contract who doesn't have to agree to any of those things. So, that's one of my concerns. Or can you do the first one, and then if you decide to do another one, you just have to meet the second and third criteria, or for second and third transactions. Again, that seems like it would have been really simple to clarify in the regulations how that would play out, but that wasn't done. So I don't know. But we will continue to try to get answers for you, and I think that the main thing that I can tell you about this is we don't need to panic because we have a little bit of time to deal with it. Business is as usual, and Ranm will, as they have, be on top of this, and as soon as we have additional information, we will get it out to you. So just make sure that you're, it's always difficult for Ranm, I know for Ranm as a whole, but for me to know how the best way to get information to our membership. We have our website that you guys can go to and these kind of things. But you just need to tell people, and you need to know that it will be there. And I think we'll probably end up sending something out to all the qualifying brokers once we have some additional clarification. And then you can always call me on the hotline. I've had people calling me regularly for the last 2 years. Do you have anything? Do you have anything? Anything new? Anything new? So you can always call me and just say, is there anything going on? You have any further clarification on it? So feel free to shoot me an email. I love this. Value of the dwelling. They won't explain to me what happens if you make one and then you do 2 and 3, but they will tell me this, that the value of the dwelling that secures the financing does not constitute evidence of the consumer's ability to repay. I just find that funny. Is it just me? So if I want to go buy this house right here, just the fact I want to buy this house somehow says I can pay for it. It's just that's the funniest statement to me, isn't it? That's just ridiculous. The value of the dwelling that secures the financing does not constitute evidence of the consumer's ability to repay. Okay, so anyway, I include that just for humor, because they don't say so many things, and yet they take time to say that. Okay, so moving on, let's just talk about not nearly as exciting stuff, but some more regulations that have come out of the Consumer Financial Protection Bureau just recently. Appraisals for high-price mortgages, also called HPML, high-price mortgage loans. Again, this doesn't take effect until next January. High-price mortgage loans can only be made if the creditor obtains a written appraisal by a certified licensed appraiser, and the appraiser must conduct a physical inspection of the interior of the property. The loans are applied to closed-end consumer credit transactions secured by the consumer's principal dwelling. Annual percentage rates are higher than normal. If it's a first, it's 1.5 more points, 2.5 on second liens, and 3.5 on third. That's how they define this high-price mortgage. The applicants must be provided with notices that the creditor is going to get an appraisal done on the property. They have to notify them, I can charge you for this, and you're going to be responsible for paying it, and to let them know that they can choose to have a separate appraisal conducted if they want to. So if they don't like what they saw the first. The creditor must provide the consumer with a free copy of the written appraisal obtained for the transaction at least 3 business days before closing. Again, high-priced loans, but in a minute we're going to talk about not high-priced loans, just standard loans in a few minutes, and what the appraisal rules all on that now. They also have under this high-priced mortgage loans, they have new category or new requirements for what they consider flipped properties. And that's where the seller has acquired the property within the last 180 days. So the borrower is acquiring the home for the price that exceeds the seller's acquisition price by 10% if they acquired it in the last 90 days, or 20% if the seller acquired the property between 91 and 180 days. And in that case, there has to be a second written appraisal required based on an interior inspection of the property at no cost to the borrower. Okay, so they have to actually do 2 appraisals on a flipped property if it's a flipped property. Exemptions from these high-priced mortgage loan appraisal requirements, qualified mortgages and reverse mortgages, loans for initial construction, temporary bridge loans, loans secured by a new manufactured home, or transactions secured by, this will be good to know if you're planning on buying a boat, you won't fall into this category. High-priced mortgage loans. I kind of thought the name said it all, but maybe not. We had some changes to RESPA and TLS servicing rules, so let's talk about those for just a minute. Servicers' obligations to provide periodic billing statements, and it doesn't apply to fixed-rate loans where you have a coupon book, okay, where they've given you a coupon book in advance. Provide interest rate adjustment notices for ARMs. These are all requirements servicers have to do now. Servicers, well, excuse me, not quite now, because you'll see that it takes effect next year as well. So this isn't going into effect for another year. Service must credit borrowers periodic payments the day of receipt and issue a payoff statement within 7 days of a written request. Servicers are prohibited from charging for force-placed insurance unless they can prove that the borrower doesn't have it, and they've notified the borrower that they need to get it, and the borrower has ignored it. So they have to document all that before they can place insurance on it. Servicers are required to meet certain procedural requirements for responding to written information requests or complaints of errors, and servicers are required to establish policies and procedures reasonably designed to achieve objectives specified in this rule. I like this next one. A servicer must establish, make good faith efforts to establish contact with the borrowers by the 36th day after the delinquency, and promptly inform borrowers of loss mitigation options. So they have to actually make a continuous effort to try to get a hold of them and let them know what's going on. If you're falling behind, I don't know if you realize you haven't made payments in 3 months, you need to start making payments. Servicers are required to maintain reasonable policies with respect to providing delinquent borrowers with access to personnel to assist them with loss mitigation. They're required to follow specific loss mitigation procedures for mortgage loans secured by the borrower's principal residence. And there are exclusions to these new servicing rules for small servicers, and they define those as 5,000 or less loans, or loans that they have originated and that they own. Small creditors. Amendments to TLN RESPA for high-cost mortgage and home ownership counseling, and it applies to loans that fall under the Home Ownership and Equity Protection Act, which are high-cost mortgages where APR or points and fees charged exceed threshold amounts, which they define. And it applies to first mortgages to the home, loan to refinance, and HELOCs. It doesn't apply to initial construction loans, reverse mortgages, or loans from HFA, agricultural, rural housing services. The lender must provide the borrower information in advance that explains what a high-cost mortgage is and states the terms and the cost of fees associated with it, and certify that the borrower has received counseling about the high-cost loan. And it bans prepayment penalties, balloon payments, late fees, payoff statements, fees for loan mods, creditor brokers from advising, and it prohibits creditors or brokers from advising homeowners refinancing into high-cost loans that they should stop making their payments on their old loans. I don't know why we have to tell people these things, but again, I know. Well, evidently this was something they're doing, so they had to create a law that says you can't do that anymore. We have some new delivery and disclosure requirements for appraisals. When a borrower applies for a loan, the lender must tell the borrower within 3 days of receiving the application that the borrower will promptly get a copy of the appraisal. So this is something that the borrower has to know within 3 days of turning in the application. And the lender has to promptly provide a free copy of any appraisal report or valuation immediately after it's done or promptly after it's done, but no later than 3 days before closing, whichever is earlier. So we should be seeing borrowers getting these earlier. They also have to inform, the lenders have to inform the borrower that the lender can require a reasonable fee for the appraisal. And they can ask the borrower to waive the deadline. So this deadline to provide it promptly or within 3 days of closing, they can ask the borrower to waive that, and then they would get it at closing. But of course, there's no requirement for the borrower to waive that.